Welcome to this Adult Education Senior University session, The Good, the Bad, the Ugly Reverse Mortgages. The presenter for this session is Joseph Kellogg. He's a certified reverse mortgage counselor with Homestead Resources. We're glad to have you with us today, Joe.
So I am a certified reverse mortgage counselor with Homestead Resources in Lafayette, Indiana. That's a certification I obtained from HUD. Uh, Homestead Resources is a HUD-approved housing counseling agency. We are not part of HUD. Housing counseling agencies are independent entities who just contract with HUD. Essentially, they certify us to show that we do things what they want, the way they want it, but it is not part of HUD. But as far as I am concerned, I am a certified housing counselor by HUD, which means that right now I'm the only guy in the state who can do them. So if you call in, they're going to give you a list of places to do the counseling, and I will be on that list along with some national agencies. I only do it within the state of Indiana. So if you're wanting counseling outside of Indiana, I ain't your guy. Sorry, that's just the way it's set up. So let's start off by just basically stating what is a reverse mortgage. A reverse mortgage, the proper term is home equity conversion mortgage. It is a mortgage created by HUD, guaranteed by HUD, allowing seniors to access equity in their property, allowing them to age in place. It was authorized back in 1987 by the Housing and Community Development Act. If you are out there shopping around, you may run across some what's called proprietary reverse mortgages. Those are not guaranteed by HUD. Those are by individual lenders. So I will not be talking about those in detail because I don't know anything about them. Each lender has their own programs with own recommendations of how things should be done, etc. Essentially, though, what they're used for primarily is very high income properties because HUD does have a limit of 1.2 million that can be used on a home. Around here, we don't have to worry about that too much, but some California may, that sort of place. Some places do have homes worth that much. Those where proprietary reverse mortgages are primarily used at. Next slide. Okay, so what type of property can a reverse mortgage be used on? There's a wide variety. They can be used on 1 to 4 family dwellings, which mean as long as the owner lives in one of those dwellings, which means if you own a property that has 4 apartments, as long as you're living in one of those apartments, it is eligible for a reverse mortgage. Seems a little weird to say that, but that's just the way it is. Primarily, you're looking at 1 family dwellings is what you usually see, but it can be 1 to 4. Any condominium that is approved by HUD may also receive a reverse mortgage. I would say probably 95% of the condominium complexes out there are HUD approved, but you just want to check if you do have a condominium, is it HUD approved condominiums place? And then if a property's in trust, you can get a reverse mortgage. It just requires that all the remainders, which basically the people who get it after you're dead, they have to undergo the counseling also because they have an ownership stake in the property. But properties in trust are eligible. And manufactured housing is eligible for a reverse mortgage also. Next slide. Okay. A reverse mortgage can be used on your current home, essentially where you live now, and you own that home. You can get a reverse mortgage on it. You can use it to actually purchase a home. So if you want to downsize or move to a different location, you can use equity in your current home after it's been sold to purchase a new home using a reverse mortgage. It allows you not to use all of your cash to purchase the home and still have something left in the bank. Finally, you can also use it to refinance an existing reverse mortgage. That doesn't happen a lot, but it can to obtain more funding. Primarily used for that would be if you have what's called a non-borrowing spouse and you want to get them onto the mortgage, you would refinance to bring them onto the mortgage. Talk about that more later. And then next slide. The eligibility for a reverse mortgage is actually pretty easy. You have to be over the age of 62, and you have to live in the house 6 months out of the year as your primary residence. And that is it. No credit scores required, nothing else really. That's it. You have to be an old fart like us, and you have to be living in the house. That's it. Next slide. Now, as an owner and a borrower, you are going to have certain responsibilities, just like you do with any mortgage that you might receive. First of all, you have to pay all your property taxes. That is a requirement. You must pay them online, not late. Online, you can pay them online, I guess, but you can't pay them late. So if you have a May payment and a November payment, you must pay each one individually or pay them all in May. But you can't ever have a delinquency on your property taxes. That's why you want to make sure you have all the allowable property tax deductions you're entitled to. You can check with your county auditor, and they can let you know for sure exactly which deductions you currently have and which ones you may be eligible for. Everyone should be getting a homestead. That's a good one. Over 65 may be an option if your house is worth less than 200,000, assessed less than 200,000, and have a income that is lower toward the lower end. I think it's under $17,000 a year of earned income, and that is not Social Security. So that would be an over 65. If you're disabled, you can get a disability exemption. Nothing on there about house or income, just if you're disabled. If you're a veteran and have a disability, another exemption you can get, which is if you're service-related disability, it's a big one. But that is one way to lower your property taxes, and you want to make sure you have every property tax deduction you're entitled to make that as easy as possible to get those property taxes paid. You must pay and keep your homeowner's insurance policy going at all times. You can't allow it to lapse. You must maintain the property, and by maintain, they simply mean you cannot allow it to depreciate in value through something that you do. So if a tree falls on it, you got to repair it, replace it however it goes, but you got to do something. You just can't leave it sit there. So maintain does not mean they don't care if you cut your grass or anything like that. They're looking at making sure the property does not depreciate. And failure to do any of these could result in a foreclosure. There is not a lot of leeway that HUD has built into the law, so just sort of stuck with it. You got to do it, or you could end up in a foreclosure. Next slide. Now, what are some of the common uses? There are lots of uses you can have the reverse mortgage for, but the three primary ones I run across: number one, to pay off the existing mortgage on the property. As we get older and retire and go on Social Security, we do not make as much money. It's as simple as that. Therefore, the mortgage that was easy to do, 10 years ago, all of a sudden, when we're on Social Security, is not quite so easy to handle anymore. So this would allow you to actually pay off that mortgage, actually get a little bit more money in your pocket. You can use it to obtain funds for repairs or upgrades. So you need a new furnace, need a new roof, need to replace your windows, need to put in a ramp or a handicap bathroom, something that costs you money that you don't have. You can get a reverse mortgage, do those repairs without actually having to have a payment at the end. Or you can just use it to build reserves for future uses. Get a nest egg. That's about it. So you don't know what you need it for now, but at some point in time, you may need some money for something that's costly. Next slide. Okay, so a reverse mortgage can be fairly complicated to understand, but essentially what it comes down to is they're going to give you a percentage of the home's value today that you are going to use for whatever purpose you need. And that percentage is going to range between 32 and 54% of the home's value, depending upon primarily your age, but also what they call the expected rate, or what they expect the rates to do over the next 10-year period. The older you are, the higher percentage you're going to get. The younger you are, the lower that percentage is going to get. So that's why it's such a wide range of 32 to 54. 54, you're looking at probably 80 or above. 32, you're looking at, you're just hit 62 and you're at the bottom bracket of it. So the interest rate itself is made up of three components. You have an index value, lender's margin, and the FHA mortgage insurance. The index value is a 1-year treasury note. It is an auction held on Wall Street every Monday. They simply have an auction of the T-bill rate, whatever that is at the end of the day. That is what the index value will be for the next 7 days. All lenders are going to use that same index value, and it is the only part of the adjustable rate that is going to adjust at any point in time during the mortgage life. Secondly, you have the lender's margin, which is important because it's going to help to most part determine how much money you're going to get. But lender's margin is an amount that the lender's going to add to the index value that they get to keep each month as their income. The higher that lender's margin, the less money you're going to receive. So you want to make sure you're getting the lowest lender's margin possible. But once you get it, it is going to be fixed for the life of the loan. It will never, ever change. It's always going to be that lender's margin. And your mortgage insurance is going to be determined by HUD as 0.5%. It will be fixed for the life of the loan also. 3 components, 2 of them are fixed. The lender only has control over the lender's margin. That's the only thing they have any input into. With a reverse mortgage, you are still going to be the owner of the property. Lender is not going to have any ownership in the home. So if you were to die, the lender does not get the property. So anytime you hear people complaining about, the lender's coming and take grandma's house from me, it is primarily because people didn't follow the rules of what they should be doing. They didn't do what they were supposed to do. Lender will only foreclose if you do not notify them that you're deceased and what you're going to do with the property. Loan operates on what's called negative amortization. What that means is you are not making payments every month, but there is still interest that has to be paid. So what happens is that interest is simply added to your loan balance every month. So your loan balance is building and building and building until such time as the loan's paid off. No end in sight. So the loan balance just gets higher every single month. The longer you live, the higher that balance is going to become. So there's no limit to how high it can actually get. And next slide. The loan, however, will come due at some point in the future. We just don't know when that's going to be. It is going to come due at a specific life event. So the first event that could occur is when you decide to sell the property. You are still the owner of the property, so you can sell at any time. And sell also just means you can pay off the mortgage at any time. Nothing says you have to keep the property forever. Having a mortgage is a decision. Nothing says you can't pay it off at any point you want. So if you hit the lottery and you have a big pile of cash, you can pay off the reverse mortgage if that's what you want to do. There's no penalty at all. You just do it. Second time it comes due is when you leave the home for 12 consecutive months, and this would be the last surviving borrower. So by leaving is primarily going to be probably a medical condition. You could just plain move out if you wanted to, but primarily they're looking at a medical condition where something has happened. You're no longer living in the home. Maybe you developed Alzheimer's and can't stay by yourself anymore. Could be you fell and broke a hip and have to go into a rehab facility. That's going to take a couple months probably. So something goes wrong and you no longer can walk and you can't get back into the house, or you need to do some repairs to the house so you can live in the house. You're going to have 12 months for that to play out. So if you can get back in the house within 12 months, nothing happened, essentially. If it takes longer than 12 months, the thinking is if it took you 12 months, you probably are never going to be able to get back into that house. That's the way of thinking. So the last time the loan comes due is upon the death of the last surviving spouse. So what we're talking about there is you can get this reverse mortgage, walk out of the closing, one of you gets hit by a bus, nothing is different. We're always going to be talking about the last surviving borrower, technically usually spouse, is going to be what triggers the whole event of when this loan comes due. Next slide. So a reverse mortgage does have some downsides. First one is decreasing equity means there's going to be less money available to your heirs at your death. So if your whole plan is to leave a big stash of money for your kids, you might want to rethink a reverse mortgage because that may or may not happen. They may get money and they may not get anything. People who are in the household who aren't on a loan or don't have any ownership have no rights to the property or credit line. So if your kid moves in with you, something happens to both of you, that child has to either get out or buy the house from the estate. It's as simple as that. They just can't stay there. The reverse mortgage ends when the last borrower is no longer alive or with us or in the house. If you are a caregiver, so say you're elderly and you're taking care of a disabled child, you may want to rethink things because upon your death, that child is now going to be out in the world on their own. So you want to have a plan in place for that child, have another child who's going to take care of them, or have a home set up for them somewhere else besides where they're currently living. So that's something to think about if you're a caregiver for a child or even a parent for that matter. If you use your credit line, use all the money up you have coming to you. It's all gone. There's no more available. That is it. So if you need more money, you got to come up with it out of your own pocket now. And a reverse mortgage is not cheap. It is expensive to obtain. It's going to take probably about 5% of the home's value. Or since you don't get all the home's value to begin with, probably 11 to 13% of the funds you actually receive are going to be tied up in closing costs. So those closing costs are going to be the upfront mortgage insurance that's going to be paid to HUD to get your loan set up in the FHA insurance pool. That's going to be 2% of the home's value. You're going to have a loan origination fee paid to the lender, which is simply a pot of money paid to the lender to do the loan. That's all it is. It's to pay for their internal operating costs of doing the loan. They're not sharing with anybody else. This is all their money. That can be up to $6,000 depending upon the value of your home. Mostly it's going to be less than that, but it can be $6,000 if you really have an expensive home. And then you have other closing costs, which are just basically the closing costs you would see with a normal mortgage transaction. Things like title insurance, document preparation, recording. They're going to do a flood zone examination, and they're going to do things like a survey, at the surveyor's office to make sure that your property is sitting within all the buildings are sitting within the property boundaries. No one's encroaching, that sort of thing. Make sure that there's not going to be any issues going forward about the location of properties. And next slide. But there are some upsides. As I said, you don't have a mortgage payment anymore. So if you got the reverse mortgage to eliminate the mortgage payment, you essentially gave yourself an income increase because you just no longer have that debt that you were paying each month. So it is an increase as far as you're concerned. You have more money available. You can build funds for future use. What that future use is sort of up to you. You can use it for a new roof, new windows, take the wife to Las Vegas for a honeymoon. Who cares? Anything you want, you can use the money for. It is not restricted to the property. I've had people buy cars with it. Mostly they're just, having it there for a nest egg, something in the future, in case something pops up. You can use it for possible future income in the case of a spouse dying. If you have two people receiving Social Security, one of them dies, the lesser of the two Social Securities is going to go away. So you're going to experience a loss of income. If the credit line has been allowed to build over time, what's going to happen is you can now pull money out every month to try and replace some of that lost income to make your life a little easier to live simply because you have that income to replace. And then you can have access to funds in case of an emergency. So furnaces, for example, do not send you an email stating I'm going to die on March 31st. They just conk out. They just stop working. And in Indiana, in the middle of January, maybe that is not the best thing that can happen to you. So if you need money to get a furnace replaced, a reverse mortgage is a good place if you have the money in the credit line. It's right there. It doesn't take long to access it. So it's very simple, very fast, and that's what it's designed to be used for. Next slide. Now, there are some gray areas you want to be aware of. Now, as I said earlier, you have to be over the age of 62. What if one of the spouses is under the age of 62? That means they are what is considered a non-borrowing spouse. Talk about that in the next slide, I think it is. But a non-borrowing spouse just means you're not eligible for a reverse mortgage, but you are an owner. This is just a categorization to make it able to get a reverse mortgage on the property. If you're receiving Medicaid or food stamps, does not mean you cannot get a reverse mortgage. It just means you want to be careful about how you use the money, simply because there are some limits on the assets you can have under those programs. So if you have a reverse mortgage, you don't want the money to build up in your accounts. You want it to build up in the reverse mortgage accounts. And if you have bad credit, doesn't mean you can't get a reverse mortgage, but it may put some wrinkles into how the whole thing is handled. Lender's going to perform what's called a financial assessment, where they're going to be looking at your ability to pay your taxes and insurance, which we talked about earlier. If you've had a problem doing that in the past, odds are pretty good you're going to have a problem doing it in the future. So they're looking at late property taxes. Have you been late making your mortgage payment? If you've been late more than one time, late more than 30 days, I guess, in the past 12 months, that's a red flag. If you've been more than 2 times 30 days late on a credit card in the past 12 months, that's another red flag. If you have delinquent federal debt, like you owe income taxes, or you have delinquent student loans, those are items that are going to be flagged that have to be paid off at the time you get the reverse mortgage. And it's going to trigger what's called a life expectancy set aside. They're going to take the money available to you, going to withhold funds to set up an escrow account to pay the taxes and insurance for you going forward. The last thing the lender wants to do is foreclose on a reverse mortgage. This is just a requirement by HUD to make sure that does not take place. Next slide. So I talked about a non-borrowing spouse. That is anyone who's on title under the age of 62. And there are 2 categories of non-borrowing spouses. You have an eligible non-borrowing spouse and an ineligible non-borrowing spouse. Eligible is your spouse or anybody who lives with you on title who's under the age of 62. That's all it means. Just means they're under 62, but they're on title. They're going to undergo the counseling, have all the things that normally go on, no big deal. Just a matter of when the borrower dies, the non-borrowing spouse is no longer eligible for any of the monies in the credit line, but they will be entitled to stay there for the remainder of their life if they can establish ownership to the home, which normally wouldn't be too big an issue, but it could, in certain circumstances, get ugly. An ineligible non-borrowing spouse is simply someone on title who does not live in the home. You put your child on the title to the home to ease things over, upon your death. No problem. It's just a matter of they're on title, so they have to undergo the counseling, but they're automatically going to be ineligible, which means they have no rights to this property whatsoever at any point in time. Period. End of discussion. They're only on there because of the title. Does not mean that you can't do it. It's just a matter of, if I have a preference, I wouldn't really be there. But another ineligible person might be an ex-spouse who we never took their names off the title. They have to undergo the counseling. So if you lost track of them, could be a problem. So you always want to keep track of ex-spouses. Okay, next slide. So as I indicated, an eligible non-borrowing spouse could run into problems. They can stay in the home if they can establish ownership. But if you set the home up in a trust, for example, The ownership upon the death of the borrower is going to go to what's called the remainders, or basically the recipients of the trust. Hopefully, the wife was the recipient, or the spouse was the recipient. But if that's not the case, could be some issues, particularly if maybe this is a second marriage for both people. Both have children from a previous marriage, and the trust, the property is to go to the children of one of those spouses, not both. So let's just say John Brown marries Mary Smith. John has kids from his first marriage. They don't like Mary, and he dies, and they are the recipients of the trust. Ownership is now with them. She cannot establish ownership, so they could technically evict her, sell the property, and pocket the cash. So that's why, you want to be careful about maybe how you set up a trust to make sure that everybody's going to be protected. Set it up so that she can stay there, and then upon her death, it goes to the kids, whatever. But just make sure that, if you set it up a trust, you do it the right way. Non-borrowing spouse, as I said, has no access to any funds. No credit line that's eligible is going to be available to them. They have to make their own way on the money they currently have. And this is a permanent condition. It never can be changed. Once you're a non-borrowing spouse on that mortgage, you are going to be a non-borrowing spouse forever unless you refinance into another reverse mortgage when you're both over the age of 62. Then they become a borrowing spouse. So don't let anyone tell you, oh, all you got to do is put your name on the title, or you automatically become eligible when you turn 62. That's not the case. Once you're a non-borrowing spouse for that mortgage, you are always going to be one until you get rid of that mortgage. Next slide. And then you have Medicaid and food stamps. As I said, Medicaid and food stamps will not prevent you from getting a reverse mortgage, but you want to make sure your assets are kept below what the standard for the state is. Generally, that's $1,500 for one person and $3,000 for two people. It varies from state to state, but the idea is that when you put money into an account, a checking account, savings account, whatever, they are going to check those whenever they do their little checks, usually once a month or so, to make sure that you're still eligible. So if you put a big pot of money in there and you're over assets, that are going to pull whatever benefit you're receiving, and you'd have to re-certify, do the whole application again, the whole thing to get back on. So if you're on Medicaid or food stamps, pay attention to how much money you're taking out. Never take out any more than what you absolutely need at that point in time. Next slide. So the process for getting a reverse mortgage is, number one, you can contact a lender or a counselor. Does not matter what order you do those in. Personally, I prefer it if you contact the lender first, because they're going to give you a printout of what you can expect to receive. I call them loan comparisons. If you've contacted the lender first, they're going to give you what's called an access code. The access code you give to me or any counselor, and we can put it into a website where we can pull up what was sent to you. The reason being it's good is because at that point in time, we know a couple things. Number one, we know what the lender's margin is that they are going to use. If you come to us first, we're going to send you loan comparisons that just so made up numbers, because we don't know for sure what lender's margin is going to be. It allows us to know exactly what they think the lender's going to be. Lender thinks the property's worth. We can see what the lender is giving you for closing costs, for other closing costs. That's important because that is also a number that our computer just chucks in. There is some kind of a rhyme or reason to it, but it rarely is what the lender says it is. Just be aware of that. So if you contact lender first, just makes the counseling a little bit easier for you to understand, because you're not looking at two different sets of numbers. After that, you're going to undergo the counseling. Generally takes about an hour. We're going to discuss with you pretty much what how the reverse mortgage works, what the numbers mean, how the whole concept flows so you understand where the numbers come from. Going to discuss how the loan amortization on this loan could work in the future. Be aware that the loan amortization is not going to be accurate because too many things. We don't know what the interest rates are going to be in the future, so we're guessing on those. We don't know what the home values are going to be in the future, so we're guessing on those. Just be aware that it just gives you an idea of what could happen in the future. Once you've done the counseling, you're going to supply the lender with the counseling certificate provided to you by the counselor. They will then do an application. They will also then conduct an appraisal to get a final value of the property. Appraisal is something you're going to pay for, so be prepared to pay out a chunk of $600 to $800, somewhere in that range, for an appraisal. At that point, then the numbers can be finalized by the lender, so they now know exactly what the property's worth. So all the numbers are now going to be pretty standard as far as calculation. Loans generally going to be closed in 30 to 45 days. No longer than a normal mortgage, just pretty standard. And unless it is a purchase, you will have a 3-day right of rescission. So if you currently live in your home and get a reverse mortgage, you sign the papers on Monday, you're going to have 3 business days to make up your mind if you really want to proceed with this thing. So you can always back out after you've signed the papers. With a purchase, that is not an option because you don't have title to the property. So if when you do a purchase, you're stuck. That's it. That's the end of the line. You're now in a reverse mortgage, whether you like it or not. And next slide. Okay, advice. Compare rates. As I said, the lender's margin is determined by the lender. It varies from lender to lender. Just because one lender is offering you 2.5, another lender might give you 1.8. Another lender might give you 3 on the same property, just a different lender. So compare your rates, what you're looking at. Any difference in rates that they give you, it's going to be in the lender's margin. Just be aware of that. Look for the lowest expected rate. The lowest expected rate is going to give you the most money. The expected rate is made up of the lender's margin that's quoted to you plus a 10-year T-bill rate. It is calculated the same time as the 1-year T-bill rate every Monday. It's just what they expect rates to do over a long period of time. And then to give you an example, 2 70-year-olds, identical houses, both worth $225,000. One of them got a quote with a lender's margin of 1.875. The other got a quote with a lender's margin of 2 3/4. The lower lender margin, they're going to get $81,257.50 on their home. The other person only gets $72,000. So it's like a $9,000 difference. You can avoid that just simply by shopping around to make sure you're getting the lowest rate possible. Because the lowest rate is always going to be the lowest lender's margin. It's as simple as that, because everything else is determined by someone else besides the lender. So always look at the lowest expected rate. Know why you're wanting to get a reverse mortgage. What are you wanting to get out of this thing? Don't go into the idea, well, it sounds like a good idea. You want to be having a clear idea. I want to get rid of my mortgage payment. I want to have funds available for a future use that I don't know what that is yet. I just know it's going to happen. I'm going to need some money. So basically, you want a nest egg. Have a plan in place for your usage of this money. Let your loved ones know of the existence of a reverse mortgage. In other words, don't keep it a secret. If they don't know there's a reverse mortgage, they are not going to be notifying anybody when you die. And if they do not notify the lender when you die, it's going to end up in a foreclosure. So let your children, let the executor of your estate, someone know there's a reverse mortgage so that they know what they need to do. Contact the lender, let them know of your passing, provide them with death certificates, and let them know what they're going to do with the property. Sell it or keep it, one of the two. Ask questions. There is no stupid question. I've heard them all. If I don't know the answer, I say I don't know. But ask questions. If you don't understand something, find out, ask the question, why is it this way? Make sure you look at your property tax exemptions so you know what your property taxes can be as low as possible. Have a budget, know what you're spending your money on. As long as the outgo is less than the inflow, you're great. But you want to have a budget to make sure that you're not spending more than you're bringing in. If you are, you have a problem and you need to address it and get it straightened out. And lastly, have a will. A will isn't required, but it's going to make life a whole lot easier when you're deceased, simply because without the will, the state is going to step in and determine who gets the property. They may give it to all your children. And if you had a kid that you didn't like, or you don't know where they're at, now there's a problem is that they're an owner to the property and no one can do anything without that person being around. And they're going to get any money that might come from the sale. So it's just a matter of have a will to determine who's to get the property, who's to be getting the proceeds from the sale. Just get things straightened away so that you have things all in order. And next slide. And if you already have a reverse mortgage, pay your property taxes. Check and make sure you have all your deductions, but make sure you get those property taxes paid. Pay your insurance. Keep the property repaired. Have a will. Communicate with the family. Let them know what's going on. The last thing you need is for them not to find out upon your death there's a reverse mortgage. They need to do something. All right, so I wrapped up in about 40 minutes. I want some questions.
Thank you so much, Joe. That was a lot of really great information. I feel much more educated about reverse mortgages now. Thank you. So our first question in chat is about the topic you were just talking about with like wills. What if someone doesn't have any children? Could they put the property in their business trust, will, or foundation? What is a recommendation there?
Okay. I don't have any recommendation because I'm not a planner, a financial planner, but I can tell you, you can do anything with this property you want to do. The thing about it is, once you die, the mortgage has to be paid off. Therefore, whoever you leave it to has to do something to pay off that reverse mortgage. What they want to do is, if you want to leave it to a charity or anyone else, that's fine. They were probably just going to sell the property, which is, once again, fine. They can sell it. Whatever they get for it, they get to keep. Thing about a reverse mortgage, it is insured by FHA, so that no matter what happens to that mortgage balance, you will never have to pay more than the home sells for, as long as you're selling it, a third-party arm's length transaction. So use a realtor, whatever they sell it for, loan's going to be paid off. FHA will then pay off the remaining amount through a claim. But they can leave it to anyone you want. If you want to put it in a business trust, fine. The business is probably going to have to pay that sucker off, but that's it. If you don't have any kids, that's no big deal. I've had people just say, well, I don't know, I'll just let the lender take it back. Well, lender can always foreclose too, I guess. That's no big deal. But if you do have a will, the executor, if you don't want the lender to have it, they can just have the property deeded back to the lender. So there's any number of ways you can do it.
Great. Thank you so much, Joe. All right, Joe, the question in the room is how much can you pay monthly or even yearly on the reverse mortgage? I'm assuming paying it back.
Yeah, a reverse mortgage does not have any required payments. Anything you pay will be applied to the interest on the loan. Therefore, if you want to keep the balance from getting higher, you can just pay the interest as it comes due. Anything over the interest would go on to the principal, just like any other mortgage. So the thing you want to be aware is if you have a plan to make payments on this reverse mortgage every single month, you want to be aware that if you miss a payment, no one is going to be contacting you about it. Okay, because it's not required. If it's not required, they're not going to contact you. So if you want to make payments, feel free.
Thank you, Joe. We do have another question in
Yes,
chat. And so does 62 mean 62 and 1 day?
62, period. You can do it on your birthday.
Okay.
In
And
fact, I've done counseling for people who are under 62. When you do when a lender does a loan, the certificate you get is going to be good for 180 days, 6 months. So you can get the counseling before you're 62. Lender simply doesn't close the loan till your 62nd birthday. Simple as that. You're good. You don't have to be 62 to do the counseling. Got to be close, but you don't have to be 62. You have to be within 6 months of it.
okay, great. Thank you. And a
Mhm.
follow-up, if you want to rescind the loan, are upfront costs refunded?
Yes. Just like any other loan, if you exercise that 3-day right of rescission, anything you pay is going to be refunded.
How does it work if you use a reverse mortgage to buy a new property?
Okay. Well, first of all, by new, make sure you understand it has to be a home that is actually built. You can't use it to build a home. But if you um, just going out, you're going to buy a house, period. What we do is it operates pretty much the same way. I put in a home value, which is what you're paying for the property. And then we put into the program your age and all that other good stuff. It automatically spits everything out. And it will say, you need this much money. The normal person on reverse mortgage is going to say you're going to get this much money, and it's going to be, positive number. When you're purchasing, it's going to be a negative number, but it's going to be the same percentage. So if you're going to get 40% of the home's value, you take 40% of the purchase price. That's what you're going to get. Everything else you need in cash. As far as cash, it can be from your current home. If you're going to sell a home, as long as you have the cash from the sale of that home when you do the loan, do the reverse mortgage, you're good. You just can't borrow any money to get the money to pay for the down payment for the reverse mortgage.
How do you calculate the equity? Is it the time you lived in the property or before you buy it? So there's some more information about how equity is calculated.
Equity is the value of the property minus what you owe. Period. That's it. That's equity. So when you start out, the property's worth some figure, which we put in. I go to Zillow to get that. A lender pretty much does the same thing. There's a lot of online valuation systems. We pretty much pick a value that those online valuation systems use. And then you're going to tell us, do you owe anything on the property? No, I owe it free and clear. So we're going to put 0 in for the amount owed. If you owe 60,000, we put in you owe 60,000. Equity is simply the difference between those. That's what we mean by equity.
The question in the room, is it possible for your property to not have any equity?
When you get the reverse mortgage, or
Before you get it. So
no, if you owe as much as what the property's worth, there is a reverse mortgage is not going to work because you got to have a lot of equity to pay that future interest. So if you get a reverse mortgage and you owe as much as it's already worth, you're going to be paying essentially the value of the property out of, well, not the value of you're going to be paying a whole lot of money out of your own pocket. A lot of money out of your own pocket. So you're going to need probably at least 60% equity in the property. In other words, you only owe 40% of its value before you even really want to think about a reverse mortgage. Unless you're really old.
it doesn't appear we have any more questions. I just want to point out on this slide, we do have Joe's contact information and the information for Homestead Resources. Again, they're based out of Indiana. So if you're in another state, you're going to want to look up a HUD certified reverse mortgage counselor in the state that you reside in.
Now, I did mention that the non-borrowing spouse is a permanent situation unless you refinance. One thing I did not mention is that if you already have a reverse mortgage and you refinance, your closing costs are not as high because HUD gives you a credit for the previous upfront mortgage insurance you paid. So your closing costs on a refinance are much less than they would be on the first time reverse mortgage.
Good to know. Great.
So, and I would say if you have someone who's a spouse who's 60, I would say just wait. Otherwise, you're going to have to refinance it, and you could end up losing money because you're going to have money in your credit line initially. It is going to grow over time, and that growth may end up giving you more money than if you refinance later on. So maybe just wait till everyone is 62. That might be the best thing to do if you're going to be actually looking at using a credit line in the future.
Very helpful, Joe. Any follow-up questions to that? So the question was, can you do a reverse mortgage without a spouse?
You don't have to be married to get a reverse mortgage. But if you are married, the spouse has to be on the reverse mortgage either as a borrower or a non-borrowing spouse.
Even if you're the sole owner of the property?
Even if you're the sole owner, if you are married, you have to undergo the counseling. You don't necessarily have to make them a borrower. You can make them a non-borrowing spouse, but they do have to undergo the counseling.
So if someone was married and now they're widowed, what does that look like? Okay.
Then you're just the single borrower, period. The only thing it looks is if you die, the loan's coming due with your death. Because it's always how it is at the time you get married, at the time you get the loan. So if you're widowed, you get the loan and then you get remarried, you probably would want to refinance because that new spouse is no longer covered under any circumstances. They aren't anything, period. They aren't even a non-borrowing spouse. They have to be, everything is as of the time you got the reverse mortgage.
Yeah, thank you for that clarification, Joe.
Okay? It can get complicated.
Which is why we're thankful that we have counselors like yourself to be able to walk folks through this process. So appreciate you sharing all this information with everybody today. Thank you everyone for participating both in person and on Zoom. And that's all I have. Any last words, Joe?
If you think of a question, there's my email. Send it to me.
Fantastic. Thank you, Joe. Thank you, everybody. Enjoy the rest of your Friday and happy weekend.